Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending March 15th, 2024. I'm Preston Brent. Thanks for tuning in. This week's theme is the Feds will finally get to speak. They've been on a 10-day quiet period, and then come Wednesday afternoon at 2 p.m. Eastern Standard Time, we get the FOMC policy statement. And then at 2:30 p.m. Eastern Standard Time, we get boom, boom, Powell. That would be Jerome Powell. We call him Jerome Power Ranger Boom Boom Powell. He gets to speak, and it's going to be very interesting. But first, let's just jump into the week and just kind of see where we've been and how things are shaping up for this very pivotal week we got coming up. So if we look at the markets, they ended lower for the week. We had a upside inflation surprise, although a little bit of a surprise in the reaction to the market. We saw midweek we saw the CPI come in at 40 basis points in February. That was kind of in line with consensus, but the core, where if you take out food and energy, it rose up a tick more than expected by 40 basis points. But then what really affected the markets, because that didn't affect the markets that much when that came out on Tuesday, but we did get on Thursday, the PPI, it rose 60 basis points in February. That's almost double what everybody was expecting. Okay, the year over year headline PPI was up 1.6, but still very high, higher than expected. The market sold off on that, right? And we continued that sell off into Friday. We did get retail sales. It rose 60 basis points in February. And we did see online sales decline just a little bit, marking a pretty good sharp deceleration from the prior month. Okay, but all of that had the end result of moving the yield on the benchmark 10-year Treasury note to its highest intraday level since February 27th of this year. You can see the indexes all in the red for the week. The Russell being the worst performer, down 2.13%. Year to date, everybody's still in the green. The S&P's leading the way. Technology is probably lagging just a little bit as interest rates are forecast to stay a little bit higher. You can see the weekly and annual sector performance. The worst was real estate, obviously, because it's very interest rate sensitive, and with the 10-year yield going up like it did this past week on the higher prospect of inflation, all it's doing is pushing out in time the probability of a Fed rate cut. So keeping interest rates higher obviously is going to hurt those interest rate sensitive sectors. The best performer for the week, unbelievable. Energy popped up very strong, 3.84%. Okay. Had a really good week. In fact, if you look at it year to date, it took over the lead. Year to date, 9.21%. Bringing up the rear, also real estate, 2.55% year to date. Okay. You can see the PE ratio is still elevated, in my opinion. The prior 12 months, 23.17. The forward 12, 21.35. So you can already see the markets are starting to downcast forward earnings compared to the prior 12-month actual to the tune of about 9%. Okay. You can see the 10-year Treasury yield, it bumped up really 4.3% is how it closed for the week. Earnings yield for the S&P came in at 4.74. So the earnings yield over the 10-year Treasury is almost flat, 44 basis points, a little bit less than 0.5%. The real yield still is about 1.54 over the current CPI inflation rate. Current VIX up again 2 weeks in a row. It finished out the week at 14.41. Prior week it came in at 13.97. So volatility is still just kind of craftily, cunningly, quietly, silently moving higher. Okay. So that's a little bit about just at a very high, quick level what we saw in the markets this week. And then, of course, if we go over to European, across the pond over there, you can see everybody in Europe was up, right? I mean, we did see the UK unemployment rate rose to 3.8 to 3.9%. So it closed out 3.9%. And we did see wage growth. It fell about 6.1%. That's the lowest level we've seen since mid-2022 for the UK. Although the good news out of the UK is that the economy showed signs that it may be recovering from their recession in the second half of last year. GDP increased about 20 basis points from January, right? Many analysts expect the ECB also to start cutting rates in June. So that's a little bit about what we got over across Europe. You can see the only year-to-date index in the red in Europe is the FTSE right now, but just barely at 8 basis points. The Euro stocks, which are the 50 largest companies across Europe, are leading all indexes, including the US, up 10.33%. CAC 40 and DAX both just around, the DAX is about 7%. CAC 40 is up over 8%. So those two are very good. I mean, and you would think, but remember, they're in the bottom contraction consolidation phase of their recession. So the way the markets price out risk, they're believing that the bigger move now is more upside move than downside. So that's kind of what we're seeing across Europe. Of course, if we go over to Japan, you can see the Nikkei was solidly in the red again, but still leading all major indexes year to date, up 15, almost 15 and three quarters, coming in at 15.76%. Their ultra accommodative policy, they got a negative 10 basis point rate by their Bank of Japan. And he's basically just pushing this out. Markets are waiting for him to do it. And there was speculation it was going to be in Q1 of this year. Now the markets are starting to put that rate hike out another quarter. So it's driving the yen down a little bit. But that's what's given the markets in Japan such a strong start to this year, is the yen has been just so cheap. So their exports are cheap. So that's helping their economy grow, right? So we're seeing GDP in Q4 of 2023 expanded 10 basis points in Japan. So for all practical purposes, it was pretty much flat, right? But we're seeing that Japan, if they can come out of their recessionary environment, then they should, just like Europe, see a little bit more upside, and that'll put punishing downward pressure on the U.S. dollar. And then, of course, if we go over to China, you can see it was in the green for the week, year to date in the green, not by much. Um, the Chinese government, like the Japanese government, are really the only countries now that are putting money into the economy for different reasons. Obviously, China, more real estate. They got to shore up their real estate. We did see in China the CPI came in above consensus at 70 basis points. Okay. And they're coming off their Lunar New Year, so consumers did spend a little bit more. So that's a good sign that consumers are starting to spend a little bit. But their PPI fell bigger than expected, 2.7% from a year ago. And that's accelerating from January's 2.5%. So that's the 17th monthly decline in the Japanese PPI. It's the longest streak of decline since 2016 in China. And like I said, the PBOC, the People's Bank of China, is injecting, three or just almost under 400 billion renminbi into China, right, into their banking system. So they're putting a ton of stimulus out there, and they left their lending rate unchanged at 2.5%. We did get also new home sales. They fell 30 basis points in February. That's the eighth straight month of real estate prices going down. So right now, there's no sign of a consolidation or a turnaround in real estate. So that's dragging everybody else down. And I think the 5% GDP growth for this year is a bit optimistic for China. That's kind of what President Xi wants to do. I think that's a little bit optimistic, but most of the numbers that come out of China, I don't believe that much anyway. Okay, let's go over and take a look at the charts. So what I'm going to do is I'm going to take you over the E-mini S&P 500 futures. Let's get you over there, and it's all about trend lines. Okay, all about trend lines. It'll take about 5 seconds to come up on your screen, 5 to 10 seconds. And then once you get it, you're going to see the daily chart of the E-mini S&P 500 futures, and you're going to see a trend line on here. This trend line really is for the entire year of 2024. We're coming into the end of the first quarter, so end of the third month. And you can see that when we come down and touch this trend line or intraday move below it, again, it's a daily chart, we move back up. But now we're starting to get closer and closer to it. You can see the 50 EMA is trailing the trend line. And to me, if we break this trend line, one of our most obvious touch points from a technical perspective is going to be the 50 EMA, which right now is sitting right at the 5,000 level. You can see the MACD is running flat, which tells me even though the markets are moving higher, it's consolidating. And because there's nothing to really catapult the market up or down, because earnings are pretty much for all practical purposes over, we're going to just continue this momentum up. And there's trillions of dollars in mutual funds. So some of that is coming out and going into the markets, right? So that keeps the markets very liquid. And when you have a very liquid market with upside momentum, it tends to just drift higher. And then any small downside drift is quickly bought. Now, this Wednesday, we get the FOMC. The odds of a rate cut are like less than 2 or 3% for March. Right now, the markets are pricing in 3 rate cuts for the year. We get the dot plot, which is going to show where all 12 voting members are looking at and how they're going to react for the next 12 months through the end of this year into the next 12 months. And if you see the dot plot, which they do it every quarter, the last dot plot was 3 rate cuts. If they come down and show just 2 rate cuts for this year, it's going to be bearish for the markets, and it'll be a hawkish type of event. Personally, I think it's going to be 1 or 2 rate cuts this year, and that's it. It's hard to justify cutting rates in a hot market. I mean, we got strong earnings, consumers are still spending, wage growth is there. And until we see that really substantially come down, I think the Feds, they may do 1 rate cut, kind of symbolic, but I just don't see very many because the fear is reigniting inflation, and then it will be worse on the backside of that, trying to get it back down again. So I think they're going to take their time. Okay. And of course, if we come over here and look at the Dow, you're going to see the same thing. I got a trend line plotted on here for the entire year, and you can see the Dow just closed this Friday below the trend line. MACD still above 0, but it's looking like it might cross below. The 50 EMA is still trailing the trend line, but again, the 50 EMA sitting at about 38,345 is a natural target. All right. We've stayed north of this trend line, but right now we're coming back below. And you can see, and a lot of people say, well, how do you draw a trend line? I could draw different versions of the trend line. But generally, a trend line should have a minimum of 2. It's got to have 2, but the more touches outside of 2, the better. So not counting the first one, we got 1, 2, almost 3, 4. So we've got a number of intraday touches here. All right, so it's a valid trend line, guys. And you can see the 2023 closing price. The last high for the Dow was on February 23rd, and it was up only 3.62%. Right, and you can see the distance from the 200 EMA. I do not think we're going to come down to that level, but I do see a 2 to a 5% pullback. If the Feds sometime over the next 60 days, and I think we may have another little rally, a brief rally, and then a pullback of 5 to 10% in April, May, June timeframe, and then we'll settle in for a rally towards the end of the year. That's just kind of how the markets are telling me right now. It may change, but that's what it's saying right now, right? And then, of course, if we come over and look at NASDAQ, even NASDAQ, you can see the trend line on the NASDAQ 50 EMA is following that. We broke that on Friday as well. Typically, when you break a trend line, generally the next day or the day after, price action tends to retest that trend line, and then it either moves above that trend line and uses that as support, or it retests it fails, and then it moves lower than the first break of the trend line. So we're going to be watching that this week. I don't think we're going to get too much movement leading up to the Fed, all right? And then once we get the Fed, Katie bar the door, because I think we're going to see a really choppy policy statement and then a Fed press conference with markets bouncing around, trying to figure out what's going to happen. The dot plot is going to say a lot. All right. I do believe the Feds will also talk about their balance sheet this time. They haven't really done much of that this year, but because it's a quarter in, they're going to get into quantitative tightening. And the other thing you got to keep in mind is, when are the Feds meeting again, and how many rate cuts can they get in this year if they do any leading up to presidential election? They try not to do any rate cuts a month or so before the Fed election or the U.S. presidential election for appearing political, which would mean we may not get more than 1 or 2 rate cuts if they do them before the presidential election. And then we've got that, and then we got December rounding out the year. So I am of the belief that they're going to do 1, but not more than 2 before the presidential election. I just don't see 3. No way, no how. So anyway, this is NASDAQ. You can see its last high was March 8th. Okay. So about 8 days ago from today. So we're seeing some of the breakdown now from these trend lines. And then of course, if we look at the Russell is probably the worst performer for the year. And if you look at this, it's it's off the trend line, right? I mean, we had a nice little run here, and the Russell and the 50 EMA trend line are kind of running right on top of each other. So I see this as a pullback point, an obvious pullback point. You can see intraday on March 14th, which was Thursday, this past Thursday, we went in the red intraday before it closed towards the lower area of the daily range for the Russell. Okay. And remember, the Russell does not play nicely with higher interest rates. If the Feds come out and say we're going to do one or two rate cuts this year, not three, then you're going to see the Russell come down very quickly and test this trend line here, along with the 50 EMA. All the other markets will probably break the trend line too, and then the race is on for where are we going to get support, and then where is it going to start moving higher again. All right, remember, we're through earnings. So really the only thing we got to look forward to is inflationary data, wage growth data, jobs data, consumer sentiment, retail spending, those things that really can move inflation and market sentiment. That's what we've got to follow very closely, right? If we look at the equal weight, okay, you can see the equal weight is also coming down a little bit. All right, we've had this consolidated pattern as it's been moving higher, and this was the low in the middle of January for the equal weight. So it's been moving up nicely. But again, if we get two dot plot projection versus three for the remaining part of this year, then it will put some downward pressure on a lot of these indexes. So that's a little bit about what I'm seeing here on this. And if we look at the equal ratio chart of the equal weight over the S&P, you can see here the S&P, the equal weight started out performing here in February this year, and it could not keep it up, and now we're kind of running sideways. So I want to see more breadth come into the chart or into the markets, but right now it's a hunt and see and wait and see where we come with the Feds. Right, that's going to drive us probably through the uh, early or springtime of the markets. Okay, and of course, if we look at the VIX right here, well, like I said, the VIX closed up this week. You can see here this regression channel that I've had really since middle of December of last year, and this is a very stealth move by the VIX. This tells me that volatility is slowly creeping back into the markets, but you'd never know it just watching day to day action. Okay. So when we see the VIX moving up, and since mid December, the markets are way up, that tells me that generally the VIX is setting up for a bigger push higher and equity markets a bigger push lower. So just understand how the relationships work here. Okay. We're just barely in the lower half of the yellow zone, which runs from about 14 or 15 up to 20. And that gives me an indication that we can just blast higher very quickly once we get into this area. If we look at the front month skew, now that's going to go away next week. It's near the red. It's in the green, but just barely. But then again, if you look at the back month skew, the vol skew, comparing March and April volatility futures, we're deep in the green. So that tells me that anything that we get in the markets that resembles a pullback from 1 to 3 or 4%, I don't. It's going to be an opportunity for people to buy, right? I don't see a big sell-off coming unless the Fed surprise everybody this next Wednesday. I don't see a big sell-off coming here. I do see a little bit of a downside move here, but that'll be healthy for the market. And then if we look at the spread, the April over October future spread, it's deep in the red. Look at this. I mean, we're way down below 5. That just tells me that the markets are expecting nothing but bullish action for the remaining part of this year, and dips are going to be bought. Now, this can all change inside of just a matter of days or just a couple of Fed comments. That's how quick this thing can change around. But right now, the markets are not expecting that. And we all know that if the markets don't meet their expectations, then the downdraft tends to be harder than normal. We look at the bond market. All right, that's going to be moving around this week. You can see the bonds starting the year are much lower during the year, which means interest rates are higher, right? And we've seen that, which is why real estate is one of the underperforming sectors year to date, right? Because very interest rate sensitive. Same thing with utilities. And of course, if we look at the 10-year interest rate, you can see it is higher for the year, okay? You can see we started out down here and we're moving up near our 2024 highs. The last high print of the 10-year rate was on February 22nd, right? It was up about 13% from where it started this year, right? So that's a big move. These are 10-year bonds. If we look at the interest rates, you're going to see the interest rates also. Um, well, this is yeah, the interest rates. I'm sorry, the interest rate here at 4.35%, right? So these are all moving. And then if we look at the 10-year note, which drives mortgage and essentially the real estate market, again, it's moving lower, right? And when it moves lower, 10-year notes move higher. And when 10-year notes move higher, mortgage rates, credit cards, auto loans, everything, because pretty much everything in the U.S. in the consumer credit world is booked off the 10-year rate. Okay, so this higher interest rates for longer, higher credit card debt, consumer spending, I believe, is going to start to peel back. That's going to affect profit margins, which are going to affect earnings per share, and it's just a daisy chain. And then that's why I think we're going to get a bigger than normal pullback, 5 to 10% sometime in the summer months, right? I'm not expecting that now, but let's see what the Fed say. Okay. But we're still by the dip, right? If we look at the US dollar, you're going to see the dollar is stronger, okay, than most other currencies. I do believe the dollar is going to bounce around here, but the 50 EMA crossed back below the 200. So longer term, you want to be short the dollar. Longer term, you want to be long the euro, all right? The euro now is pulling back and testing the 50 EMA. But I do believe the euro is going to finish here much higher than this, so that's why we like a long euro. Same thing with the Japanese yen. Now, the Japanese yen is a lot choppier because we got the Shinzo Abe, um, who runs the, Ueda, who runs the Bank of Japan, Kazuo Ueda, I believe. I'm not sure if I'm pronouncing the name correctly. But he gave kind of a relatively downcast view of the country's prospects of the economy and the weakness in some of the data, right? And so that's causing the markets to push out in time when he begins to raise rates, right? So you can see that just caused the yen to pull back just a little bit. But if it comes back down here again, down in this area is when I said if you want to front run this and pick up some longs, I would do it. If it rolls back down here again, I think it would be the same thing, right? And then, of course, we look at gold. Gold was down on Friday. You could see it's just this is profit taken. I think any dip here in gold should be bought. I think gold is eventually going to go higher. And same thing with silver, right? Silver had a strong Friday. In fact, it hit an intraday high on Friday, the 15th. And you could see silver just blasted off. I mean, just totally blasted off. This tells me I wouldn't chase it, but any dip in silver or gold, I would be looking at it, right? And then, of course, what's really interesting is if you look at the gold miners like GDX, it's not near the highs like gold. So GDX is trailing gold, but I do believe GDX will pick it up, right? Any dip in GDX, gold miners, you want to play it to the upside, okay? And then, of course, if we look at oil, oil is now leading the way for the year. Closed down just a little bit, but you could see oil had a high mark on the 14th on Thursday. It was up 14.43%, right? You can see the MACD, even as it's running sideways and slightly higher, the MACD is coming down. That's a consolidation setup for oil, right? And I do believe oil is not going to have too much more of an upside move. And then, for members, we have nice ways to trade oil markets as we do the gold markets. It worked out fairly well for us, right? So that would be oil. And then, of course, if we look at nat gas is down around these lows here. I had projected a lower low for nat gas. If it does give us that gift and come down to here, that is a point where you have to just, pick up longs. I don't see it staying down here very long. Nat gas does not stay down here very long, right? We're just doing huge exports to Europe. We provide like 48% of the natural gas to Europe. But Sippy Cup Joe is kind of halting some of our exports, which is causing nat gas inventory levels to go up, and the supply going up. So that outstrips the demand. And then obviously supply and demand issues, mismatch that pushes prices down when you got more supply and demand, right? That's probably going to flip the switch again and go back the other way. But for now, I'm just want to wait and see if we can get this thing lower, right? All right, everybody, that's a quick and dirty on the markets this past week. Members, I'll see you Sunday evening. We got a nice little set of things we got to review for the coming week. If you're not a member, I highly encourage you to come in and check us out. All right, everybody, have a great weekend. Members, I'll see you Sunday evening at 7 p.m. Take care, folks. Ciao now.